Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you to talk about capital budgeting decisions. This is the introductory session we are going to begin. So, we are going to talk about the kinds of capital budgeting decisions followed with certain discussion on the requirement of data, the kind of data which is required for capital budgeting decision. So friends, capital budgeting is a process where we decide about to invest in particular asset or not, to decide about to invest for cost reduction or not, to decide about investing in a building, machinery or not. So primarily we are deciding in expansions, modifications, overhauling, all such situations. So ultimately the purpose is to invest in something or some long term assets which help us generate revenue. And since this is for future, since the expense is happening today but the benefit is in future, we have to be very careful, right. So that is why capital budgeting decisions are of utmost importance for any businesses. For most of the capital budgeting decisions, the outlay is huge. It is not necessarily, even the small amount could be there, but most of the decisions in capital budgeting requires a huge outlay. So they become very important for businesses because they are affecting the profitability, they are not reversible. So we have to take them very carefully. So the total capital budgeting decisions are actually categorized into three kinds. So there are total three kinds of decisions. One is accept reject decision. Number two is mutually exclusive decision. Number three is capital rationing decision. So we will talk about them in detail. So accept reject decision is the evaluation of capital expenditure proposal to determine whether they meet the minimum acceptance criteria in independent decision or mutually exclusive decision, both, right. So accept reject decision is what? It means that this particular decision, the kind of decision is just to take either to accept this proposal of investment in X or Y asset or to reject it, right. So accept reject decision is basically is a situation when we are evaluating a proposal simply to decide that do they meet up with my minimum acceptance criteria. Let us say my cost of capital is 8%, right. As a business, I am using debt, and debt funding is relatively cheaper than the owner's funds, than equity. So my decision is either to accept is or not, or this particular investment. How would I decide? My cost of capital is 7% or 8% or 10%. It varies from business to business. Now I have to see either this particular proposal is going to give me minimum 12%, 13% or not. So my cost of capital is, which is then KO, overall cost of capital, which we calculate as weighted average cost of capital, because I may have been using the debt funding. I need to pay back. I need to pay. I need to serve the debt. People who take loans from the banks, either bank loan or project loan or term loan or debenture or overdraft facility, we need to serve that loan. Serving the loan means paying the interest. So if I have to serve that loan, that becomes my minimum requirement. So if I decide to invest in a particular asset, machinery, plant, building, so they should give me enough revenue, and after paying off all expenses, enough income or return, so that I am able to serve that debt. So that percentage of interest becomes my decision criteria. Now anybody is making business or running business not to just serve that debt, they want to earn. So businesses would have economic value added, or people may have, after debt they will add up certain percentage that we need minimum this much. So businesses have their already decided criteria of return, that my minimum requirement is 12%, 15%. So over and above the cost of the funds I am using, right. So because you are just not investing into a business for meeting the debts, or to debt cost, or meeting up the or to serve the debt. You are here to make some money, you are here to give some good return to the investors, right. So you decide your acceptance criteria. This is in terms of return. Your another acceptance criteria could be in terms of time, the gestation period, which we generally take it that businesses would say that my return should, my investment should be recovered in 5 years, 7 years, 10 years, it all depends. If we are running, setting up a hydro plant or a power plant, my gestation period is longer. If I'm going to set up a small shop for tea, coffee, or some small business, my gestation period would be less, it would be in days or weeks, right. So that's what is known as accept reject decision. Means if my proposal doesn't fit into my acceptance standard or criteria, I will simply reject it, right. So my first decision is accept it or reject it basis on the standards I have fixed up. The second is mutually exclusive decision. When the projects are that compete with one another. So I have selected out of 10 quotations, out of 10 proposals I received, there are 3 which are fulfilling my accept reject criteria, means they all qualify to be accepted, right. 7 were rejected, the 3 have fallen under the criteria of accept them. Now which means they 3 of them become competing with each other, they become mutually exclusive. What does it mean? The mutually exclusive situation means I have to select only one machine, I have to buy only one machine or only one type of machine. So I may have to buy 10 unit of machine, but only one type of machine, right. So but three different type of, or 3 brands, they were acceptable to us as per our standards, be it standard of budget, be it standard of time, be it standard of return, any such standard, be it standard of services, whatever the standards I have fixed up as a company. So these 3 machines are fulfilling those standards, means they qualified under the accept reject criteria, now they become mutually exclusive. So I need to eliminate 2 because 3 have been selected. So I need to eliminate 2 options and have to select only one, right. So I will further apply certain criteria to choose one out of the 3. So we have certain techniques which help us which help us to choose between the mutually exclusive or competing proposals. That would be, that kind of decision would be the second type. So today we are just introducing this topic. Today we are just conceptually understanding the concept or the technique. In future sessions we will be talking about actually tools which are used, or the formulas which we use to decide the mutually exclusive decision or situations. The third or the last is rationing. So capital rationing decisions. It's very simple, as the name is suggesting, we have to ration it. So which means what? No, I have limited funds, every business has limited fund. So it's a situation where firms has fixed amount to allocate amongst competing capital expenditure decision, and thereby firm prioritize investment options as per their importance. Let's take up some example. One store which is running which is car selling store, right. So distributors of car company, any brand you may take. So we go to showroom or distributor to buy a car. What do we observe? they would have good infrastructure, somebody is there at the counter to receive you, greet you, they will provide you valet service to park your car, or your vehicle whatever you go, whatever you use to reach there. There would be some kiosks where somebody is greeting you in the beginning. Then when you enter the lobby area, they will have some receptionists, they will have beautiful furniture on the reception, then they may have coffee vending machine, tea vending machine, they would have certain more facilities, air condition inside, certain cars displayed, certain good round table, some tables are there along with the chairs. There are screens where the different models of that particular brands are displayed, they are running, and so many more things. So if a car showroom guy has to set up a new car showroom, so he has X amount, he has 10 crores in hand, he has to buy the inventory, he has to deposit some amount to the car manufacturer, then he has to buy for certain units of each type of model of the car to display, he has to hire services of people, he has to hire employees, pay their services, salaries, etc., etc. Furniture, coffee vending machine, but he has limited fund. So he calls proposals for everything, be it the display LCD screen or furniture, chair, different whatever or equipments he needed. So he gets proposals, and now he puts up rank number 1. This is a must, that he need to have 4-5 car of all the colors of all the models of the car he has to sell. This is a mandate because he need to keep all the colors, right. Then he has a choice to have one LED screen or 2 LED screen to display this model. So he will, and then to have that 4 round tables or 3 round tables or 2, depending on the space, and then the space, how much space minimum these many models should be displayed, right, and how big or extravagant feel he wants to give to his clients or customers or visitors. So he will have all these requirements, quotations for all the equipments, all the machinery, all the furnitures he required, he will have quotations, and then he will choose after accept reject criteria. He will apply the mutually exclusive criteria and will decide one best option, and then he will have list of best table, best as per his criteria, best table, best chair, best desk, best LED screen and everything, floor area, floor designing, whitewash, everything, building, whatever he is using. But he has a limitation of 10 crore rupees. So he would then put in order that what is that which he must invest in. What is the second most important thing as per his understanding which must be there for customers, third, fourth, fifth, like that. So he will, if there were 10 different equipments and investment proposals which were shortlisted, finalized as per accept reject criteria, mutually exclusive criteria, but now he will ration that this is must, models, investment in cars of each type of model in each type of color is in must. He will assign certain value for 4 or 5 crore in that. Then I can do with these many number of chairs, he may reduce it, or I can do without 2 LED screens or without even single LED screen. My employees will explain, right. I will just put pictures of different models instead of showing a running presentation. So what is he doing? He is rationing, right. This is what is called as rationing decision. Here my decision is not about choosing between, my decision is choosing amongst all selected investment proposals, right. So deciding about where to stop based on the budget I have. This is the third kind of capital budgeting decision, right. So for all the three all the three situation, what I am doing, I am actually assessing that my capital budgeting decision should either increase my revenue or should decrease my cost. So two things must, either of the two things must be fulfilled. Revenue is increased or expense or the cost has gone down, right? Either of the two things must be happening. So that is my ultimate objective, to increase revenue or to decrease cost. That is the rationale we use in capital budgeting decision, right? So this was about the decisions we have and the reasoning we use in capital budgeting decision. Either revenue goes up or the cost goes down. Now we will be talking about the data which is required in capital budgeting decision, because ultimately I am going to discuss in future. We will spend couple of sessions on this capital budgeting decision. It's the most important decision in financial management. It's a quite lengthy one, quite critical one, and difficult one too for students, not for everyone. So what type of data or what all data do we need to have to decide about long term investment, which is capital budgeting? So in capital budgeting process or decisions, we use cash flows, not accounting profits, and that too we use incremental cash flows, we use incremental after tax cash flows, we use adjusted cash flows for depreciation and working capital requirement, and lastly we use adjusted cash flows after adjusting the effect on other projects. So let me explain them one by one. Accounting profits and not cash flows. What's the difference between two? What are these two terms? Many of you would understand it. Accounting profit is something which is based on accrual concept. My profit and loss account, which or otherwise the statement of profit or loss, is showing, let's say, 10 crores of profit. What does it mean? Do I have 10 crores in my bank account, in my hand? Or can I have more or less than that in hand? Can I have 12 crore in hands, or can I have 8 crores in hand? My profits are 8 crores, 10 crores as per my books. Will I have equivalent amount of cash in my hand? Just think about it. It's a very important concept or the fundamental I am talking about. Answer is no. I may not have 10 crores equivalent exact, or in fact none of the business with all possibilities, rarest of the rare business would have the exact same amount of cash in hand or in bank equivalent to the accounting profit shown by any business in their books, in their profit and loss account. What does it mean? It means we are preparing our books of account on accrual basis. This is the fundamental requirement, that we record all the transactions which has happened in one accounting year, irrespective I have paid for expenses or received the revenue, because we are selling on credit. So all the businesses especially which are selling on credit, for them the difference would be huge. Your books are showing profit based on what you sold, that becomes revenue, and whatever you spent, you may not have paid that expense, you may not have received that revenue, because we are recording on accrual basis, right? So the difference of revenue and expense is my profit. That's what is my accounting profit. But my cash flows are the ones which have the profit which has turned into, or the revenue which has turned into cash, means which has been collected, right? So the quality of the profits or the quality of sales will decide your cash amount. If you are a business which is actually promoting a lot of credit sales, right, so you have to recover those sales, so only then that sales will get converted into cash, if you are able to recover that credit sales, right. So the credit sales, basically my debt collection operation or debt management would decide how much cash has been collected out of credit sales, and the cash flow is always different than the accounting profit. So in capital budgeting decisions, we do not use accounting profit, we use only the cash flows. Let me show you one example here. that the difference between accounting profit and cash flows. So, let's say if the account, as per the accounting approach towards benefit, the cash flow approach towards benefit, the two columns have been prepared, right. So, the revenue is 1000 and 1000 in both the cases. If we subtract expenses, right, of 500 rupees for example, the after expenses, we have depreciation of 300 rupees, 300 crore it could be. So, my expense after that I have 800 total expenses as per the accounting profit, right, accounting approach. My earnings before tax are 200. If I pay tax at the rate of 35%, my tax is 70. So, after paying 70, my net operating profit would be 130. Whereas, as per the second approach, because my depreciation is non-cash item, so my accounting profit would be depreciation plus the actual profit I calculated. So, it would be 430, right. So, you see the difference. As per cash flow approach, my profits are 430. As per accounting approach, my profits are 130. Why? Because depreciation is a non-cash item, right. So, same way we could have many more expenses which are non-cash. Here I took example of one expense which is depreciation, because we do not pay to anybody, we just charge depreciation to keep the money aside to replace assets in future, or or just to calculate the taxable amount, because for exact calculation of tax, depreciation is a chargeable expense, right. So, that is the difference between accounting profit and cash flows. So, this was the first thing. Second thing, incremental cash flow. What does it mean? So, incremental cash flow, I will be discussing it now. Incremental cash flow is basically the difference. The incremental cash flows means the cash flows which are directly contributing or attributing to the investment project, which they are taken into account, right. So, it is for this reason that fixed overhead costs which remains the same whether the project is accepted or rejected are not considered, because there is an increase in them due to new proposal, they must be considered, right. So, let me just explain this. We apply incremental analysis. Let us say there is a situation, I am using to produce X amount of X units of any product X. Let's say product X I am producing, and number of units are 200. So, the machine has a capacity of 300, right. So, up to 300 units, my fixed cost, that is the fixed cost in that machine is there, because I can produce, and I am paying salary to person who is running that machine. So, I can easily produce up to 300 units, because the capacity of the machine is 300, right, and the salary I am paying is to one person, whatever the salary I am paying. So, that is my fixed overhead cost. But now I want to run, I want to increase my production to 400 units. The machine has capacity is 300, and only one machine can be handled by one fabricator or one engineer. So, his salary is fixed. Now, to run the second machine, my fixed overhead cost, that is the salary of the overhead, the second person I need to hire, is going to go up. So, this is changing because of the investment decision, investing in that second machinery. I need to, so this is the incremental analysis. So, this increased expense in the salary, which is the fixed nature overhead cost, right, is simply because I decided to invest in the second machine, of course, to meet up the new demand, the extra demand I am having. So, this incremental expense becomes important. So, that was an example of investment project causing an incremental overhead fixed cost, right. So, we apply this incremental analysis. Now, so that incremental expenses are, so first thing we decided that we will take cash flows, Then the second thing we decided, we will not take accounting profit and we will take cash flows. The second thing, only the incremental, only the increase, the difference between the two, the current and the new expense will be taken, that either it revenue or expense for both. Only the increase, if I am investing in new or overhauling of a car, right. So, my earlier fuel cost for 1 month was 20,000. If I overhaul the machinery, my fuel cost would be 12,000. So, what I am saving 8,000. So, to me, the difference is important. Earlier it was 20,000, now it is 8,000. So, I am saving 12,000. So, 12,000 is important. The difference, incremental increase in expense or revenue is considered, that is what is known as incremental cash flow. The example of the increase in salary I took is also to help you understand that. So, we call it as incremental analysis. The third thing is that we take incremental after tax cash flows. So, these cash flows are going to be taken, are considered after adjusting the tax, because we are going to save tax or we are going to pay tax, either way, depends upon its increased revenue or decreased cost situation. So, incremental cash flows after tax are taken, not the total cash flows, and they are adjusted for depreciation and they are adjusted for working capital. So, we always adjust the incremental cash flows for depreciation. I will just help you understand that how do we adjust. So, depreciation is something which is an expense which is allowed to be considered by tax authorities, and depreciation is something which help us to pay less tax to the government, right. So, we first reduce the depreciation as I showed you in this example, and then we add back. That is how, so we just reduce the depreciation. In this example you saw it few minutes ago, right. We reduce the depreciation of 300 rupees in this example, and we then later on we added back. So, that is how my cash flows become 430. So, this particular adjustment is taken as the adjustment for cash flow. So, the last thing I will discuss is the working capital. Now, what is working capital? Working capital is investment is in current asset, be it cash itself, be it bank balance itself, be it salaries, be it paying for rent, insurance. This all is my investment is current inventory, right. So, not expenses, the cash which is required for to be kept in current assets, so is taken as, is known as current working capital. So, because of any proposal, if my requirement for working capital goes up or high, right, what do I need? My increase working capital will go up or my working capital requirement would go down. Either of the two can be possible. So, what does it mean? Earlier my machine which was there, it was using only two employees, right. So, I was paying salaries of those 2 employees, which is investment in working capital. But because of this new investment or overhauling the machine, I am going to save, my requirement would be only one person. So, I am going to save the salary of one person, right. So, my working capital requirement goes down. Or let us say you were paying or energy bill or electricity bill for X amount. Because of the new machine, new system, new equipment, you are going to save it, or maybe it is going to go up. So, that is the change in working capital. So, current assets minus current liabilities could be net working capital or gross working capital. It all depends the business what they are using. But if my working capital requirement is going up because of this capital investment decision, so that is considered. If it is going to go down, it is also considered. And if working capital is going to get released at the end of 5 years, 10 years, that is the terminal year of the investment, we are going to consider that cash inflow in the terminal year, be it 5 year or be it 20 year, right. So, this is called working capital adjustments in the terminal year, in the first year or in between. So, maybe after 2 years my working capital requirement goes up, requirement for energy goes up, requirement for rent or space goes up, or for people goes up or go down. So, we adjust the cash flows for depreciation, for working capital, for any other project too. So, if I am going to have increased revenue because of this investment, but it is going to affect my sales of the other product, so that difference on the other product is also going to be considered. So, this is known as adjustment for effect on other. So, these all is considered ultimately to take the data for working capital. So, I hope you could understand the exact data which is required for capital budgeting decisions. With this, I would like to wind up now. Friends, thank you very much.